dream. He was a young man, 27 years old, buying his first car. The dealer was selling it to him for more than £1,500 its true value. The lender wouldn't lend more than the Glasses guide price. The dealer got him to take out a further personal loan, effectively to pay his commission.
In August 2025, the UK Supreme Court delivered a ruling that reshaped one of the most closely watched consumer finance disputes in years. At the center of the case was the so-called car finance commission scandal, which campaigners and the press had described as potentially worth up to £44 billion in compensation. For many drivers who had financed their cars through personal contract purchase, or PCP, it seemed like justice was finally within reach. The court, however, decided otherwise. In its judgment, the justices concluded that while undisclosed commissions between dealers and lenders raised concerns, they did not automatically make every agreement unlawful. Instead, only cases that could show an unfair relationship would be eligible for redress. This meant that the vast majority of claims, which consumer groups had hoped might mirror the mass payouts seen in the earlier PPI scandal, would not go ahead. Estimates quickly shifted from tens of billions to a far smaller figure, perhaps between 5 and 15 billion, reserved for the most serious cases. The decision triggered strong reactions. Banks and finance companies welcomed clarity and relief from what could have been a record-breaking compensation bill. On the other side, lawyers and consumer advocates expressed disappointment, calling it a setback for millions of ordinary motorists. The outcome left many asking, how did Britain reach this point? Why did a product like PCP, once marketed as a simple and affordable way to drive a new car, end up at the center of such a high-stakes legal battle? To answer those questions, we need to look back at how PCP works, why it became so dominant, and how hidden commissions turned a popular finance tool into one of the country's most debated scandals. To understand why the car finance commission scandal grew into such a major issue, it's important to look at how personal contract purchase, or PCP, became the dominant way of buying cars in the UK. Introduced as a flexible alternative to traditional loans, PCP allowed drivers to make relatively low monthly payments over a fixed period, often 3 or 4 years. At the end of the contract, the customer could either return the car, pay a final lump sum to own it, or trade it in for a new vehicle. This system proved hugely popular. By the late 2010s, industry figures showed that more than 80% of new private car sales in the UK were being financed through PCP or similar products. Dealers promoted it as a way to make vehicles more accessible, and for many households, it opened the door to driving models that might otherwise have been out of reach. However, investigations later revealed that the structure also created opportunities for conflicts of interest. In some cases, dealers were paid commissions by lenders, and those commissions could increase if customers were signed up to higher interest rates. According to reports from the Financial Conduct Authority, the FCA, these discretionary commission models meant dealers had an incentive to recommend deals that were more profitable for themselves, but not necessarily the cheapest for the customer. The issue was not that commissions existed, many sales industries rely on them, but that they were often not clearly disclosed. As consumer groups pointed out, this lack of transparency made it difficult for buyers to know whether the rate they were offered was really the best available. In 2021, the FCA moved to ban these commission structures, stating that they created an unacceptable risk of harm for consumers. By then, though, millions of PCP agreements had already been signed under the old system. This laid the groundwork for a surge of legal claims as drivers began to question whether they had paid more than they should have. The stage was set for years of litigation, mounting media coverage, and growing comparisons to the PPI scandal that had dominated headlines a decade earlier. What had started as a popular way to finance cars was now becoming one of the UK's most contentious financial debates. By the mid-2010s, questions about how PCP agreements were being sold had begun to surface. Some customers compared their contracts and noticed wide differences in the interest rates they were paying, even when their credit histories were similar. Consumer forums filled with complaints, and journalists started to dig deeper into the issue. Investigations by outlets such as The Guardian and Sky News reported that many car buyers were unaware of commissions being paid to dealers. These reports suggested that higher interest rates were not always a reflection of customer risk, but in some cases linked to the amount of commission a dealer could earn. The story struck a chord, particularly because millions of people had taken out PCP deals in the preceding decade. Consumer advocates, including well-known figures like Martin Lewis, began to highlight the issue in the media. Lewis described the situation as potentially a $44 billion car finance scandal, drawing comparisons to the earlier payment protection insurance (PPI) mis-selling crisis. The scale of the numbers captured public attention. If the claims were upheld, compensation could run into tens of billions of pounds, making it one of the most significant consumer finance cases in British history. At the same time, the Financial Conduct Authority, FCA, launched a review of commission models. In early findings, the regulator concluded that discretionary commission arrangements created a conflict of interest, as dealers had the power to set higher interest rates for their own benefit. In January 2021, the FCA officially banned these practices, calling them unfair to consumers. The ban, however, did not resolve past cases. Millions of agreements had already been signed under the old system, and the question of compensation loomed large. Soon, law firms began advertising services to help drivers file claims. Promises of potential payouts drew comparisons to the wave of PPI refund claims that had dominated UK finance for years. Momentum grew further when the Court of Appeal ruled in 2021 that undisclosed commissions could be unlawful. The judgment gave hope to claimants, suggesting that the courts recognized the lack of transparency as a serious problem. Headlines spoke of a looming financial reckoning for banks and lenders. For a time, it seemed as if Britain was on the verge of another historic payout scheme, this time centered not on insurance, but on the way millions of people had financed their cars. Following the Court of Appeal's ruling in 2021, public expectations around compensation rose sharply. The decision suggested that car buyers who had been signed up to PCP agreements without being told about dealer commissions might be entitled to redress. Consumer groups and law firms quickly drew parallels with the Payment Protection Insurance (PPI) scandal, which had resulted in more than £38 billion being repaid to customers. The prospect of a repeat, this time in the car finance sector, dominated headlines. Law firms specializing in group litigation began encouraging drivers to check whether they had been affected. Advertising campaigns appeared on television, radio, and online, inviting people to submit their PCP agreements for review. For many households, the idea of recovering thousands of pounds in overpaid interest was compelling, especially at a time when the cost of living was rising. Media coverage amplified the sense of anticipation. Reports from consumer advocates estimated that potential claims could amount to as much as £40 to £44 billion, depending on how the courts interpreted the law. This figure was staggering. If realized, it would rival or even surpass the scale of PPI. News outlets described the situation as a ticking time bomb for Britain's banks, warning of major financial consequences if lenders were forced to pay out. For individual drivers, the discussion was less about balance sheets and more about fairness. Many felt they had trusted dealers to provide the best available finance deal, only to discover that hidden commissions may have tilted the terms against them. Interviews with claimants showed people who believed they had been misled and who now hoped for recognition as well as compensation. The financial sector, meanwhile, braced for impact. Banks and lenders disclosed the potential risks in their reports to shareholders, warning that billions might need to be set aside to cover claims. Analysts speculated about the effect such liabilities could have on profitability and whether the industry could withstand a payout of that size. By 2023, with claims mounting and legal arguments intensifying, the case seemed headed toward a definitive resolution. For campaigners, it appeared only a matter of time before lenders faced an unprecedented bill. For banks, it was a moment of deep uncertainty. And for millions of motorists, it was a waiting game, one that seemed poised to deliver long-awaited justice. In August 2025, the long-running debate over car finance commissions reached its climax at the UK Supreme Court. After years of legal challenges and public speculation, the justices handed down a ruling that dramatically changed the direction of the case. For millions of claimants, the decision came as a shock. The court acknowledged that the practice of paying undisclosed commissions to dealers had been widespread, and that it raised legitimate concerns about transparency. However, it concluded that such commissions did not automatically render every PCP agreement unlawful. Instead, the court emphasized that compensation would only be available in situations where an unfair relationship between the lender and borrower could be proven. This was a narrower interpretation than many consumer groups had hoped for. The practical effect was clear. The vast majority of claims were unlikely to succeed. Analysts quickly revised their estimates of potential payouts, which had previously been described in the range of 40 to 44 billion pounds. Instead, the figure was reduced to somewhere between 5 to 15 billion pounds, covering only the most serious or clear-cut cases. Reaction was swift and divided. Consumer advocates expressed disappointment, describing the ruling as a setback for ordinary drivers. Law firms that had prepared for mass claims faced uncertainty about how many cases they could still pursue. Meanwhile, banks and finance companies welcomed the judgment. Share prices in several major lenders rose, reflecting relief that what could have been one of the largest consumer compensation bills in history had been largely avoided. The Financial Conduct Authority responded by announcing that it would continue to review the situation and consider additional measures to ensure fairness. Officials suggested that a redress scheme might still be created for customers who could demonstrate particularly high or unjustified costs, though any such scheme would be more limited in scope than the one many had envisioned. For millions of motorists, the outcome was disappointing. After years of coverage framing the scandal as the next PPI, the Supreme Court's ruling effectively closed the door on widespread payouts. It was a reminder that legal outcomes do not always match public expectations, even when regulators and campaigners raise concerns. The ruling marked a turning point. The scandal that had once been described as a potential $44 billion reckoning for the financial industry was now something much smaller, though still significant. The final chapter would be written not in court, but in the broader discussion about lessons, regulation, and consumer trust. The Supreme Court's 2025 ruling did not end the debate over car finance. While it closed the door on mass compensation claims, the case left a lasting mark on public trust, the financial industry, and regulators. For millions of drivers, the decision meant that the refunds they had hoped for would not materialize. Even though commissions had been banned in 2021, many felt they had been misled in earlier years and now had little recourse. For the banks and lenders, the outcome brought relief. A potential 40 to 44 billion pound liability, which could have rivaled the PPI payouts of the previous decade, was reduced to a much smaller figure, estimated between 5 and 15 billion pounds. This spared the industry from a financial shock that some analysts had warned might destabilize balance sheets. Yet relief in the boardroom did not erase reputational costs. Headlines about hidden commissions and secret profits damaged public confidence, and some customers became more cautious about finance agreements in general. Regulators signaled that their work was not finished. The Financial Conduct Authority indicated it would consider further steps to protect consumers, possibly including a limited redress scheme for those who could demonstrate that their agreements were especially unfair. Even if such measures never matched the scale of PPI, they reflected an acknowledgement that the system had not worked as transparently as it should have. The broader lesson of the scandal lies in transparency. PCP became the most common way to buy cars in the UK because it appeared simple and affordable. But the reality was more complicated, and a lack of clear disclosure meant many buyers were not in a position to make fully informed choices. The episode showed how quickly trust can be eroded when financial products are not explained openly. For consumers, the case is a reminder to question terms, compare offers, and understand the fine print before signing a finance deal. For regulators and industry leaders, it highlights the need for ongoing vigilance to ensure that innovation in finance does not come at the expense of fairness. The story of Britain's car finance commissions may not have ended with the sweeping payouts many expected, but it has become a case study in how a widely used product can spark controversy, reshape regulation, and leave a lasting impression on both an industry and its customers.